Okay, let's talk a little bit about money, banking, and financial institutions. Okay, so there's three main functions of money. The first one is medium of exchange. So if I want to buy a sandwich, I don't have to give an economics lecture in order to acquire a sandwich. Instead, I use the money that I've earned from my salary and I buy my sandwich. And so I exchange, let's say the sandwich is $5, so I exchange $5 in order to have my good. So before money was around, what people did was barter. So I would, sell two chickens in order to get a jug of milk or whatever. But now that we have money, we can buy and sell goods without having to barter. It's also a unit of account. We know how much a good is worth because of the price that is set. And since the price is set in dollars, it's easier for me to compare the value of goods. It's also a store of value. I can save my money, let's say, hypothetical, I have a piggy bank, I can put it in there and use it in the future to buy something else. Put it in a savings account, for example, a CD, etc. Money is liquid, meaning that I can use it right away. Cash is the most liquid asset. And how fast you can use something as a function of money. So how fast something, for example, can be used as a medium of exchange determines how liquid it is. So cash is the most liquid. Something like a house or an exotic painting is not very liquid because first, in order to get the money from it, I would have to sell it, and that takes time. Uh, in between cash and something like a house, it would be like a savings account. A savings account is more liquid than a house, but less liquid than cash. So how easily something's accessible and ready to be able to be used as a function of money determines its liquidity. Okay, so the money supply consists of M1 and M2. So M1 is currency and checkable deposits. Checkable deposits is money that can be accessed on demand just by writing a check. So both of these are very liquid, especially currency, because currency is coins and the paper money. Checks are around because they're safe and convenient. If we have to write a large, or if we have to pay someone, let's say $10,000, it's much safer and easier to just write a $10,000 check and mail it off versus stuffing $10,000 in a box and sending it. If that box gets lost, then we can't do anything about it. The box is lost, the money is lost. Whereas with a check, we can do a stop payment, etc. The primary depository institution are commercial banks. Most of us keep our money in commercial banks such as Wells Fargo or Bank of America. There's also savings and loans associations. These are called like thrifts. Also, credit unions. Credit union is essentially a non-profit bank, so they're able to offer lower interest rates, for example, for people who want to take out a loan. Okay, so M2 includes everything in M1 plus what we call near monies. Okay, so near monies are financial assets that are fairly liquid, but they need to be first converted into currency before they can be used as a medium of exchange. So, savings deposits, which also includes money market deposit accounts. So, with savings accounts, first money has to be transferred to a checking account, and then it can be used, withdrawn or used as a check as a form of a medium of exchange. Whereas with currency and also checkable deposits, a check can be immediately written as a medium of exchange, or cash is immediately used as a medium of exchange. Whereas the saving deposits, it takes a couple of steps before that money can be used as a medium of exchange. Same with money market deposit accounts. These are interest-bearing accounts and they have securities. And so usually there's a limit on how often a person can take that money out, and sometimes there's even a penalty. And it's usually a couple times a month only that they can withdraw that money. So it's not as easily accessible, again, as currency or checkable deposits. Small denominated deposits, these are, for example, such as CDs or certificate of deposits, where you leave your money in an account for a time period. And if you withdraw before that time period was up, then you would incur a fee as well. And then money market mutual funds, again, in order to access the money in these accounts, an individual has to go through a series of steps, and it may take 2-3 days before the individual actually gets access to that money. So near monies are not as liquid as currency or checkable deposits. And so M2 is all the near monies plus everything in M1. Okay, so if we look at money supply, it's on the left. This is for 2013, February 2013. Okay. M1, okay, 45% of M1 is in currency and 55% is in checkable deposits. Now, M1 makes 24% of M2. And a big part of M2 we see is savings deposits. And then, we have 6% money market mutual funds, and then 6% small denominated time deposits. Okay, so what backs the money supply is the government's ability to keep the value of money stable. Okay, it's, the government has to be responsible and engage in policies, and the Federal Reserve as well, that keeps the value of money stable, because money is issued as debt. Money is exchangeable only for more money. So, you can redeem a $10 bill for 2 $5 bills. Okay, but the $5 bill intrinsically is not worth more than, let's say, the $1 bill. Okay, they're both made out of the same material. The only reason the $5 bill is worth 5 times more than the $1 bill is because the government says so and backs it up by keeping the money supply stable. In the past, the money supply was tied to how much gold the government had in reserves, but this led to a lot of constraints in controlling the money supply. So the Fed was not able to freely conduct monetary policy, which is the setting of the money supply, which then influences interest rates. So if the supply of gold were to fall, then the money supply would be reduced, interest rates would shoot up, and this could lead to recession and unemployment. And if the supply of gold were to rapidly increase, then the money supply would also rapidly increase and could lead to high levels of inflation. So, once the government stopped using gold to back the money supply, the controlling of the money supply became much less restricted and actually easier to control. It actually became more stable. So money is valuable. We know that the intrinsic worth, the monetary value of the paper that money's printed on is not worth a lot, but, money is worth whatever it says it's printed on. For example, $100 bills is worth $100 because we accept it to be so. If I tried to give a store owner $100 of Monopoly money, they would laugh at me and not accept it. But since $100 of American money, is widely accepted, then they would accept it, and I would be able to walk away with $100 worth of goods and or services. Okay. It's also legal tender. The government says that paper money is valid and a legal means of paying any debt. And it's relative scarcity. So in this economy, we do demand money in order to be able to buy goods and services. So the supply of money will help set the price levels of money and the value of it. And we'll discuss this more next chapter with monetary policy. Price has an inverse relationship with the purchasing power of money. So the higher prices go, the less purchasing power money has. So think about it, if you buy, let's say a candy bar is 50 cents, and with $1, you can buy 2 candy bars, and then the candy bar goes up to $1, and now with $1, you can only buy 1 candy bar, and if it goes to $1.50, $1 wouldn't even be able to buy your full candy bar anymore. So inflation erodes the purchasing power of money. Hyperinflation makes money unacceptable. Hyperinflation occurs when there's a very rapid rise in the money supply, which then causes the price level to increase rapidly as well. And essentially one day milk, can be $4 a gallon, and then the next thing you know, it's $30 a gallon, and then it's $100 a gallon, and then it's $200 a gallon, and essentially money becomes worthless and people resort to barter. If prices are rising rapidly, then people don't want to use it as a medium of exchange because they know that the next day the money will be worth less. Also, it's worthless as a store of value since, again, it's losing its value rapidly, and it's no longer a stable unit of account. So to keep money's purchasing power stable, the Fed needs to practice responsible monetary policy, and the government also needs to practice responsible fiscal policy, because the government spending money rapidly is often what can lead to hyperinflation, as we saw in post-World War II Germany and what goes on currently in Zimbabwe. Okay, so before banks were centralized and regulated under the Fed, each bank could conduct their own monetary policy and also issue out their own form of currency. And so as you can see, this led to a lot of monetary mismanagement, and some locations had rapid inflation because the banks there were printing too much money. Others had printing too little money, and it was hindering economic growth. Some banks were experiencing crisis and run on the banks, etc. And so the Federal Reserve was then established in 1913 to help centralize the banking system and also regulate it so that banks would operate more smoothly. All right. So the Federal Reserve, or the Fed as it's called, is like the godfather of the banking system. Okay. It consists of 12 Federal Reserve banks, a board of governors as well, and they control the lending activity of nations' banks, and they control the money supply as well. They act as a lender of last resort. They issue currency, and they set reserve requirements. The Fed is governed by the Board of Governors. A board member serves a 14-year term, and their terms are all staggered so that a new member is replaced every 2 years. The president gets to elect the chairman and the vice chairman, and the chairman and the vice chairman serves 4-year terms, and then they can be reappointed by the president for another 4-year term, and they can serve as many 4-year terms as presidents want. So like Alan Greenspan started under Ronald Reagan. He kept getting confirmed all the way until he decided to step down, and then President Obama appointed Ben Bernanke at the time. Now it's Janet Yellen. Other countries such as Britain and Japan have just one central bank, but because the United States has a very diverse economy and a huge geographic size, we have 12 Federal Reserve banks, and they each have different functions, but collectively they serve as the central bank. Each of the 12 banks are considered quasi-public banks. They are privately owned, but governmentally controlled. Each of the Federal Reserve banks are owned by the private commercial banks in their district. But their policies, however, are designed by the Board of Governors, and since they are not motivated by profit, then the policies are designed to promote the well-being of the economy. They don't compete with commercial banks, so that, the Federal Reserve Bank of Dallas does not compete with Wells Fargo, for example, but they interact with commercial banks and the government. They're also a banker's bank. Just as a commercial bank, for example, will accept our deposit and make loans to us, Federal Reserve banks accept deposits and make loans to commercial banks. So therefore, they're called the bankers' banks, and they're also called a lender of last resort. If a bank needs a loan to make it liquid, then the Federal Reserve can give that bank a loan. And the Federal Reserve, played a huge role as a lender of last resort during the financial crisis in 07, 08, when a lot of banks were going under or were becoming illiquid, meaning that they weren't bankrupt, but they just didn't have enough cash on hand. Okay, so we can see here we have the Board of Governors. The Board of Governors are also part of the Federal Open Market Committee, and this is a committee that decides on monetary policy. So it includes the 7 members of the Board of Governors, the president of the New York Federal Reserve Bank, and then 4 of the remaining presidents of Federal Reserve banks on a 1-year rotating basis. Okay. And they dictate monetary policy by deciding how much to buy or sell of government securities. And we'll talk more about this in chapter 30 through 34. So the 12 Federal Reserve banks then implement the decisions of the FOMC, and that affects commercial banks and thrift institutions, which then affects the public, which includes households and businesses. Okay, so you can see where the 12 Federal Reserve banks are over here in the regions that they cover. So you might have seen a Federal Reserve Bank here in Houston off of Allen Parkway. It's actually part of the Dallas Bank. Usually the FOMC meets in the Federal Reserve Bank here in New York. Okay, like mentioned before, the Federal Open Market Committee acts with the Board of Governors in setting the monetary supply. They do this by conducting open market operations, which is the buying and selling of government bonds to increase or decrease the money supply. Then that would affect interest rates. They also oversee commercial banks and thrifts and regulate them, for example, by setting reserve requirements for these banks and thrifts. Here we can see the world's 12 largest private sector financial institutions. Deutsche Bank has, almost $3 trillion in assets. HSBC has just above $2.5 trillion. Here in the U.S., JP Morgan Chase has almost $2.5 trillion. Bank of America, similar to JP Morgan Chase. And then we also have Citigroup with about $2 trillion in assets. Okay, so as discussed earlier, some of the Federal Reserve functions, they control the money supply through open market operations. They supervise banks. They go and they make sure that the banks are profitable and that they're in compliance with regulations. They issue currency. They set reserve requirements. So, each bank has to have 10% of their deposits on hand. They also serve as a lender of last resort. They can lend money to banks in case of financial emergency, and also they can make short-term loans to banks and thrifts that are just temporarily illiquid, and they charge them an interest rate called the discount rate. It also collects checks. If a person writes a check from her bank and then gives it to someone else, and then they deposit it in their bank, which is different from the original bank that the check was written from, then the Fed will adjust the deposits of the two banks. They also are a fiscal agent for the U.S. government. The government also, collects revenue through taxation, and they also spend money, and then they, buy and sell bonds. And so these activities are carried out through the Fed's facilities. So Congress wanted the Fed to be shielded by political pressures, and this is so they can help counteract fiscal policy. So if fiscal policy is very expansionary and inflation is becoming a problem, then if the Fed was also part of the government, then they would also have a lot of political pressure, and they might engage in expansionary monetary policy, which would worsen the problem of inflation. And so Congress wanted the Fed to be independent and help do what's best for the economy versus giving in to some political pressure that might worsen the economy. And so, it was established as an independent agency. And again, the way the Board of Governors are elected in the longer terms helps shield the Fed as much as possible from political pressure. Okay, the financial crisis of 2007 and 2008 has many complex causes, and it had been years in the making. And this video that I have attached here is excellent in giving you an overview of the many forces at work that caused the financial crisis of 2007 and 2008. So please take a few minutes and watch it. It's very easy to watch, and it's fairly quick.
The crisis of credit, visualized. What is the credit crisis? It's a worldwide financial fiasco involving terms you've probably heard, like subprime mortgages, collateralized debt obligations, frozen credit markets, and credit default swaps. Who's affected? Everyone. How did it happen? Here's how. The credit crisis brings two groups of people together, homeowners and investors. Homeowners represent their mortgages, and investors represent their money. These mortgages represent houses, and this money represents large institutions like pension funds, insurance companies, sovereign funds, mutual funds, etc. These groups are brought together through the financial system, a bunch of banks and brokers commonly known as Wall Street. While it may not seem like it, these banks on Wall Street are closely connected to these houses on Main Street. To understand how, let's start at the beginning. Years ago, the investors are sitting on their pile of money, looking for a good investment to turn into more money. Traditionally, they go to the U.S. Federal Reserve, where they buy treasury bills, believed to be the safest investment. But in the wake of the dot-com bust in September 11th, Federal Reserve Chairman Alan Greenspan lowers interest rates to only 1% to keep the economy strong. 1% is a very low return on investment, so the investors say, no thanks. On the flip side, this means banks on Wall Street can borrow from the Fed for only 1%. Add to that general surpluses from Japan, China, and the Middle East, and there's an abundance of cheap credit. This makes borrowing money easy for banks and causes them to go crazy with leverage. Leverage is borrowing money to amplify the outcome of a deal. Here's how it works. In a normal deal, someone with $10,000 buys a box for $10,000. He then sells it to someone else for $11,000. For a $1,000 profit, a good deal. But using leverage, someone with $10,000 would go borrow $990,000 more dollars, giving him $1 million in hand. Then he goes and buys 100 boxes with his $1 million and sells them to someone else for $1,100,000. Then he pays back his $990,000 plus $10,000 in interest. And after his initial $10,000, he's left with a $90,000 profit versus the other guy's $1,000. Leverage turns good deals into great deals. This is a major way banks make their money. So Wall Street takes out a ton of credit. makes great deals and grows tremendously rich, and then pays it back. The investors see this and want a piece of the action, and this gives Wall Street an idea. They can connect the investors to the homeowners through mortgages. Here's how it works. A family wants a house, so they save for a down payment and contact a mortgage broker. The mortgage broker connects the family to a lender who gives them a mortgage. The broker makes a nice commission. The family buys a house and becomes homeowners. This is great for them because housing prices have been rising practically forever. Everything works out nicely. One day, the lender gets a call from an investment banker who wants to buy the mortgage. The lender sells it to him for a very nice fee. The investment banker then borrows millions of dollars and buys thousands more mortgages and puts them into a nice little box. This means that every month he gets the payments from the homeowners of all the mortgages in the box. Then he sicks his banker wizards on it to work their financial magic, which is basically cutting it into 3 slices: safe, okay, and risky. They pack the slices back up in the box and call it a collateralized debt obligation, or CDO. A CDO works like 3 cascading trays. As money comes in, the top tray fills first, then spills over into the middle, and whatever is left into the bottom. The money comes from homeowners paying off their mortgages. If some owners don't pay and default on their mortgage, less money comes in and the bottom tray may not get filled. This makes the bottom tray riskier and the top tray safer. To compensate for the higher risk, the bottom tray receives a higher rate of return, while the top receives a lower, but still nice return. To make the top even safer, banks will insure it for a small fee called a credit default swap. The banks do all of this work so that credit rating agencies will stamp the top slice as a safe AAA rated investment, the highest, safest rating there is. The OK slice is BBB, still pretty good, and they don't bother to rate the risky slice. Because of the AAA rating, the investment banker can sell the safe slice to the investors who only want safe investments. He sells the OK slice to other bankers, and the risky slices to hedge funds and other risk takers. The investment banker makes millions. He then repays his loans. Finally, the investors have found a good investment for their money, much better than the 1% treasury bills. They're so pleased they want more CDO slices. So the investment banker calls up the lender, wanting more mortgages. The lender calls up the broker for more homeowners, but the broker can't find anyone. Everyone that qualifies for a mortgage already has one, but they have an idea. When homeowners default on their mortgage, the lender gets the house, and houses are always increasing in value. Since they're covered if the homeowners default, lenders can start adding risk to new mortgages, not requiring down payments, no proof of income, no documents at all. And that's exactly what they did. So instead of lending to responsible homeowners, called prime mortgages, they started to get some that were, well, less responsible. These are subprime mortgages. This is the turning point. So, just like always, the mortgage broker connects the family with a lender and a mortgage, making his commission. The family buys a big house. The lender sells the mortgage to the investment banker, who turns it into a CDO and sells slices to the investors and others. This actually works out nicely for everyone and makes them all rich. No one was worried because as soon as they sold the mortgage to the next guy, it was his problem. If the homeowners were to default, they didn't care. They were selling off their risk to the next guy and making millions, like playing hot potato with a time bomb. Not surprisingly, the homeowners default on their mortgage. which at this moment is owned by the banker. This means he forecloses and one of his monthly payments turns into a house. No big deal. He puts it up for sale. But more and more of his monthly payments turn into houses. Now there are so many houses for sale on the market, creating more supply than there is demand, and housing prices aren't rising anymore. In fact, they plummet. This creates an interesting problem for homeowners still paying their mortgages. As all the houses in their neighborhood go up for sale, the value of their house goes down, and they start to wonder why they're paying back their $300,000 mortgage when the house is now worth only $90,000. They decide that it doesn't make sense to continue paying, even though they can afford to, and they walk away from their house. Default rates sweep the country and prices plummet. Now the investment banker is basically holding a box full of worthless houses. He calls up his buddy, the investor, to sell his CDO, but the investor isn't stupid and says, no thanks. He knows that the stream of money isn't even a dribble anymore. The banker tries to sell to everyone, but nobody wants to buy his bomb. He's freaking out because he borrowed millions, sometimes billions of dollars to buy this bomb, and he can't pay it back. Whatever he tries, he can't get rid of it. But he's not the only one. The investors have already bought thousands of these bombs. The lender calls up trying to sell his mortgage, but the banker won't buy it, and the broker is out of work. The whole financial system is frozen, and things get dark. Everybody starts going bankrupt. But that's not all. The investor calls up the homeowner and tells him that his investments are worthless. And you can begin to see how the crisis flows in a cycle. Welcome to the crisis of credit.
In response to the failure and near collapse of other firms, Congress passed a troubled asset relief program. It was $700 billion in emergency loans to financial institutions, and they had bailed out, for example, AIG, etc. But when Lehman came up for a loan, the government, there was a concern for moral hazard, and this is, if you start bailing one person out, then you have to bail everyone out, and if they get a bailout, if they're too big to fail, then will they have any incentive to be more careful next time? And so they didn't give one to Lehman. Lehman collapsed. That collapse scared investors, and the stock market fell dramatically. And so when they realized what effect one of the banks failing had on the economy, then they proceeded to bail out other banks and save them from failure. Okay. So the Fed's role as a lender of last resort dramatically expanded during this time period. Many people credit the Fed's aggressive actions from saving the economy from a Great Depression. We had the Great Recession, but many say that the Fed hadn't been so aggressive, and if the government hadn't been so aggressive, we would have been in a depression. So in order to have a bigger role and be able to lend more money, Ben Bernanke essentially created new lender of last resort facilities in order to be able to pump more money into the financial system. And so, for example, he designed the primary dealer credit facility, and these provided overnight loans to dealers who were willing to use loan-backed securities as collateral. He also created the term securities lending facility, and it's similar to the primary dealer credit facility, except that They lent U.S. securities to primary dealers for 1 month terms in order to have liquidity in the markets. Asset-backed commercial paper money market, mutual fund liquidity facility. Wow, that is quite the name for this one. This one provided loans to U.S. banks and thrifts to finance the purchases of commercial paper. Commercial paper, consisted of asset-backed short-term IOUs, and these were vital in helping businesses continue their day-to-day operations. The commercial paper funding facility. This helped the short-term credit needs of businesses be financed. The money market investor funding facility. This provided money to help ensure the liquidity of U.S. money market mutual funds. So that way there wasn't a mass withdrawal of money market mutual funds. Also, term asset-backed securities loan facility. Okay, and these help households and businesses with their credit needs. They provided funding support for asset-backed securities collateralized, by student loans, auto loans, credit card loans, etc. And interest payment on reserves. This increased the profitability of banks by paying interest on their results they hold in their vaults or in the Federal Reserve Bank. So it was another way of providing liquidity to banks. Of course, the concern again is of moral hazard. If all these institutions were bailed out by such great lengths, then again, and if they think that they're going to always get bailed out because they're too big to fail. Okay, they're too big to fail, meaning that they know that if they fail, the economy goes down with them. Then what will stop them in the future from taking hazardous risks? Okay, so it's a big source of discussion. Okay, so here are the major categories of financial institutions. We'll actually look at them in more detail in the next slide. Okay, so commercial banks, these are like, for example, Wells Fargo, Bank of America. They're state and national banks that provide checking and savings accounts and make loans. Thrifts are like New York Community Bank, Charter Ones. They're saving and loans associations. They're credit unions, and once again, credit unions are a nonprofit bank. And they offer similar things that commercial banks do. And then we have insurance companies. They offer policies against loss. Mutual fund companies, they pull customer deposits and then they buy stocks and bonds. A lot of people use this to fund their retirement. And then pension funds, they collect savings from workers and then invest the funds to pay retirement benefits. Securities firms, these are like Merrill Lynch, Smith Barney. Once again, a lot of people use these firms for their retirement funds. Workers there will give advice and buy and sell stocks for clients and build their retirement. And then investment banks. And these firms help corporations and government raise money by selling stocks and bonds. So Goldman Sachs, Morgan Stanley, for example. And sometimes the commercial banks have an investment bank function. So they're not always all separate. Sometimes one institution will have several of these functions with them. So the Wall Street Reform and Consumer Protection Act was passed to help increase regulation on banks to prevent, a crisis like this from occurring again. This also included a Financial Stability Oversight Council that helps monitor risks to the financial system and raise red flags if something seems overly risky. It also requires companies that sell asset-backed securities to keep a portion of the securities so that they also share some of the risk. Because if they don't take any of the risk, then they may engage in more hazardous practices. However, there's a lot of critics to this act. They say that all this regulation imposes a great cost to these institutions. And it's something that you often hear about still on the campaign trail. Some politicians are saying they would reverse this act and deregulate the banking system again. All right, this concludes chapter 32.